Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is mean reverting. So the obvious trade is always the expensive one to
This
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been
If you don't
talking
know
about.
who you are, it's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life. Hey everyone, welcome back to The Big Picture. I'm Joe Cruey, looking at everything crypto vol markets here at Paradigm, joined today by our macro specialist, David Brickell. And unfortunately, we had a couple last-minute guest cancellations, unanticipated. So we don't have a guest this week, and we'll definitely be back with one in the next episode. So this episode is going to feel a bit more like the first days of The Big Picture, when it was basically just me and David going back and forth when we didn't have guests. And what we're going to do today, examine some crypto vol thematics that we found interesting over the past couple weeks. Though we are going to lead off with the macro today, and I think it's quite timely, given the recent CPI release and some pretty puzzling Bitcoin spot action after the print that some people were attributing to some Silk Road wallet movements. But David, let's start with you in the macro. What's going on?
Yeah, well, Joe, looking forward to stripping it back to where we started, man. So yeah,
It's weird, right?
Yeah, and actually, it's quite timely, right? To with the first half of the year in the bag, to like start looking ahead to what we're expecting into the second half. And I think in terms of thinking where we're at on the macro, I think first thing is like we came into this year pretty bullish, right? And certainly which felt non-consensus at the time. And that bullish thesis was based on this peak rates, peak inflation narrative as the market transitions from an aggressive hiking cycle to the pause. And we've seen that play out pretty well. Nasdaq's led equities higher, and obviously Bitcoin is outperforming all assets once again. Kind of offsetting that a little bit and spoiling the story a little bit has been the lag data, which has shown, I guess, a resilience, and the pace of disinflation has probably been slower than I expected, and certainly more than the central banks would like. But I think the key point on the macro is that we are peak inflation. It's coming down. I think the kind of stickiness and the slowness of it has kind of stopped markets fully embracing this pause thematic. But nonetheless, we're moving there, and I think we're going to see that move accelerate as we move into the second half of the year, and you see those sort of lagged impacts start to feed through. And I guess case in point, and with the chart up there is to look at yesterday's CPI number, which came in at a weaker 3% year on year. Joe, this is like the 12th straight month of year-on-year declines on the headline CPI.
Yeah, we got it in that chart right there. I mean, 3%.
Yeah. And look, go back.
Doesn't feel like that way in the UK though, right?
No. I mean, like, I kind of think we're on a lag to where the US was. I think obviously that there's been a few things probably a bit more exposed to some gas and energy over here. Maybe a little bit of Brexit kind of causing some problems on the food inflation side as well. But I think we'll kind of follow the US lead. And yeah, just look at that, right? A year ago we were at 9.1%. We're now down at 3%. I think it's kind of crazy that the Fed, still talking more hikes and sounding hawkish, that they've broken the back on inflation. So yeah, and I think we're just going to see that move accelerate into the second half of the year. I think market now, I mean, July looks a lock, right, for a hike. I don't see why. I think if you paused in June to give yourself time to assess the data, we've since had a weaker non-farm payroll print, we've had a weaker inflation print. So I'm not really sure what the Fed look at to go, oh shit, we need to hike rates again. But it's the Fed, right? They're going to do it in a way. But it looks like, if we say it again, it looks like that's probably the last one. And then we can kind of fully embrace that pause narrative. So and also just backing that number up, we had earlier just today, we had PPI out, and that was 0.1% year on year. Now again, that was 9.8% a year ago. So like this is a very, very different backdrop in 2023 than what we saw in 2022. And this disinflationary pulse is really going to help risk assets. It's going to draw us to the end of this hike cycle, and ultimately, I think it's going to be super positive for crypto into the second half of the year. The other thing as well, like we always talk about sort of rates and liquidity. Like liquidity still pretty much bottomed about October of last year. Now it's a bit of a complex concept to kind of measure, but I think kind of big picture on the liquidity front. You've seen the Bank of Japan and Bank of China. They're sort of pumping liquidity hard, and that's been quite a big offset to what we've seen from the Fed and the ECB. I mean, the Fed, obviously, we had the banking crisis in March, and they sort of pumped $400 billion onto the balance sheet. That's since tapered off, and we are lower on the year. But again, the liquidity tightening hasn't been as severe as many would have thought coming into this year. So I think that's a lot more positive. I was worried, as you know, when I sort of turned bearish a month or two ago, worried about this debt ceiling hike and the liquidity drain that would mean. It's pretty much, because they've done it via T-bills, it's pretty much been offset by a drawdown on the RRP. So we've not really seen that big sort of negative liquidity event there. So I kind of think liquidity, like generally looks pretty good here. So yeah, and then you kind of on the rate stuff, right? We had that vicious sell-off in rates last week, and I commented in the macro pulse, like actually I thought Bitcoin traded pretty well, given that rates move. And the rates move didn't make sense. Certainly the kind of global nature of the rate sell-off with yields higher everywhere, because the data for Europe's been pretty poor. There's definitely a disinflationary pulse now in Europe, like PPI is in negative territory, and that will start to feed into CPI. And we'll talk a little bit about China in a bit, but obviously China is really struggling, so which will kind of weigh on global growth. So the idea that bond yields everywhere should be going up in this kind of reflation type move didn't make sense, and I don't know it's whether something technical was going on there, but obviously
yeah, I mean, it's
kind of unwound
that like BTC didn't really react too strongly when that higher for longer narrative started to really emerge again post the jobs data. But then again, I mean, look at this chart on the left, right? I mean, rates really rallied after the print, yet Bitcoin was flat to down on the day, right? So it's like flat activity in both directions, right? It's kind of weird.
Yeah.
Not used to that.
No, and like so I commented in the macro pulse, like look, once rates reverse, which I'm super bullish, like duration, like I think 10-year yields are going to come a lot lower in the second half of this year, and once that rates reversal happens, I thought that would kind of release the kind of pressure on Bitcoin, and we ramp up into sort of new range highs and towards that 35k. I was looking at it yesterday thinking, here we go, dollars selling off, yields are coming lower, quite sharply lower, Nasdaq's pumping, gold's up, I'm like come on, let's go, and once again we faded into that 31k. I don't know what's going on there. Now obviously there was lots of like talk about Silk Road type stuff, maybe that flow is happening, or the anticipation of it kind of knocked us back down. And maybe there is a flow out there, right? Like kind of reminds me of my FX days. Often when the currency didn't move how you really felt it should, you find out a few days later that there was a big flow going through. So I guess my point on it is I don't know why Bitcoin didn't really rally yesterday.
It rallied initially, right? It kind of went up to like 3,900, and I wasn't surprised to see pretty strong resistance in that 31k level. I mean, you kind of just 31k has kind of been a pretty strong resistance to break. I mean, if you just look at it on the charts, or the cup and handle patterns. And what we've actually seen is as spot approaches 31k, a lot of shorts in futures open interest is increasing, kind of really indicating. And then we hit 31k, then it immediately gets pressed down. So there's there's definitely some shorts that are being put on when we kind of get up to that level. But what was more surprising was the fact that we retraced all the way back down to the bottom of the range. We back down to like 3,400, 3,300.
But I think that for me, that's kind of classic post data price action. Like everyone sort of pays the highs in anticipation of the break, and then we don't break, and then we kind of start to move lower, and then everyone just gets squeezed out. Like, so all the short term punters are just like kind of chopping themselves up basically on those moves, and then we end back to flat, to small down. But I guess I don't really understand why we didn't move, but like everything I'm looking at, Joe, is like telling me that we should be breaking higher. I mean, look at this dollar move. I mean, since we snapped that chart, we've actually broken below 100 in the DXY. Now I think this is pretty significant, right? And certainly when I talk about liquidity, like the dollar is quite a big input into that. Obviously, as a global reserve currency, it was that strong dollar which suffocated pretty much every asset class last year. So a softening dollar is generally good for risk, good for liquidity, and good for Bitcoin. We're sort of dumping pretty hard here. And I think that's interesting because if you remember back to kind of end of November, December, when I started getting pretty constructive for risk and on Bitcoin, one of the early signals for me was when the dollar topped out. And I often say that I think FX is probably one of the best asset classes for sniffing out regime change. And it kind of, to me, the dollar was pointing us towards the idea that, we're going to start going into a slower rate hike environment. And obviously we went from 75 bips to 50, 25 wars. And I kind of think maybe the dollar's telling us, again, we're about to kind of maybe step up in terms of the move into that new sort of regime as the Fed are done. And then we start thinking about when do the rate cuts come. Not necessarily expecting rate cuts this year, but I think we're certainly coming now properly to the end of this rate hike cycle. So I think that's interesting. There's also, which is quite interesting, I've seen a lot of people talking about Janet Yellen visiting China last week. Now, China were obviously struggling with their economy. They're also struggling with their currency that keeps getting weaker and weaker. Now, I think it suits them, and they've kind of allowed it to drift. But what they don't want to do is lose control. Now, where you've got the Fed still kind of, probably going to hike again in July, and you've got this massive divergence of interest rate policy. If China really want to ease, they can't lose control of the currency. So I think they wouldn't mind guiding it weaker. So there's a lot of talk. Did they do a deal with Janet Yellen around the currency? Certainly as well, like their biggest competitor, Japan, that they've seen like huge weakness in their currency, and we've seen this sharp unwind of that dollar yen carry trade. So I don't know. There's a lot of a lot of talk out there that maybe something's been agreed, because certainly the dollar has been hit pretty hard since Yellen had a visit to China. So, and again, either way, this is pretty sort of positive for Bitcoin. And then look, talking of China, I think when I came into this year, probably one of the biggest risk factors to my bullish outlook in this peak rates, peak inflation theme was the China reopening. And the idea that, they'll see that massive boom, like post-COVID reopening boom that we saw in the West. And to be honest, it's just not happened, right? The Chinese consumer is a lot more conservative. Feels like they're probably licking their wounds a little bit. And the Chinese economy at the moment looks in real trouble. We're seeing growth slow pretty sharply. So far, the efforts they've made to try and stimulate the economy is just not working. They really need to stimulate the consumer, and it's just really not happening. So I think China's been really interesting. We haven't seen that kind of inflation pulse coming out of China, and then that chart we got there. So China's battling deflation. now, and China carries a lot of debt as well, and you don't want deflation when you've got a lot of debt. So PPI the other day was minus 5.4% year on year. So there's a huge disinflationary pulse coming out of China. The CPI numbers are negative as well. And I like that chart. China PPI, again, you've got to think they're the world's biggest exporter. So when goods in China are sort of coming, in negative territory, tends to kind of put out this disinflationary pulse around the rest of the world. And that's telling me that US CPI is going to follow sharply lower. You're seeing it in Europe actually as well, like European PPIs are negative, and I think you'll see CPI follow. So China is emitting this disinflationary impulse across the Western world, which just goes to reinforce the idea that we're at this peak rates junction, whereby, I think certainly the Fed, if they go in July, which looks like they're going to, I don't think they should, but they probably will. I think that's the last one. And I don't think the ECB have got long to go before they're done as well, because I actually think we're going to see inflation or disinflation really pick up pace in Europe. And yeah, this hike cycle that we've had to endure is looking pretty cooked right now, I think.
Yeah, interesting. I mean, I'm just I'm looking at some charts right now on some price action. It looks like Bitcoin now is above 31,000 again. It looks like there's some news, just looking through my Telegram chat live. Ripple wins verdict that XRP is not a security. Judge also rules that institutional sales of XRP by Ripple were securities. Okay, wow. So this is happening literally as we record. That is, as of now, that is not confirmed. That is just what I'm reading a Telegram chat. But I mean, Ethereum really outperforming on this, because the basis that the SEC is using to go against Ethereum as a security is pretty similar to that as XRP. So we're finally starting to see that outperformance and breakout in Ethereum versus BTC. Just looking at TradingView right now, Ethereum up on the day 3% versus Bitcoin up 1.7%, and again flirting with that 31K resistance that we've been talking about.
Yeah.
I think that's a pretty good segue into this chart right here. So kind of just to set the stage, right? Since the rally and spot went range bound, it's pretty clear that previous resistance of roughly 30K, which we saw, a couple months ago before the rally, has become this new sort of support level for this new range between 30 to 31K, with that 31K level, being a pretty strong resistance. We've yet to, meaningfully break it on a weekly or even like a 4-hour candle. I mean, hopefully this is the time where we can actually have a meaningful candle where we are above this level. And, currently spot is forming this wedge pattern in this new range as shown by the chart. And if we can meaningfully break this 31K level, there's a lot of technical analysts and chartists out there that are predicting 35 to 37K is the new level. The bullish flag patterns, as well as some Fibonacci retracements, kind of at that 35 to 37K level. We're not really a charting podcast, as you know. I'll leave it to the guys that are really good at it. Crypto Banner, Crypto World, they literally dedicate their channels to this stuff. But the consensus seems to be that if we can break 31K, then 35 to 37K is kind of the next level on the upside. And as long as we kind of remain above 29.8K, then, we're still kind of in this crypto bull market. So
yeah,
go on, Dave.
Yeah. I mean, I just, everything I'm looking at the moment from the macro, which I think is lining up like beautifully, and really sort of playing out as we were expecting. And now, we've had this positive narrative shift around crypto. Certainly, obviously, with the BlackRock spot ETF. Now, if obviously we're just hearing this Ripple news now, that potentially is quite significant in terms of, certainly for ETH, and we've spoken before about this mean reversion trade on ETH and the potential for ETH to play catch up, and the fact that we've felt that Bitcoin's been a cleaner trade, not just from the macro kind of driver element, but also it's just been cleaner because what are the SEC going to label ETH? Now maybe this is what helps us play catch up. But
right.
Macro combining with this like positive narrative then that's starting to build around crypto, I really think we're going to see some explosive upside moves.
Yeah, well, that's certainly been the case, throughout the year, right? It kind of feels like a coiled spring sort of deal, right? You have the move, chop, 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 and then you have another big move. And what we'll talk about now is, are the option flows kind of agreeing with this sentiment? And this is a new chart that we're going to start including on the big picture a little bit more. Apologize for the size of the bars. We're still working that out with the database to get this. But effectively, what this chart is showing is it's showing the taker open interest by strike and maturity on Paradigm. So let's say a taker comes in and buys 500 contracts of DEES 40,000 calls, and what that will do is that will add 500 contracts to that DEES 40K bar. So in terms of what we've been seeing on Paradigm, since this spot breakout, is the option flows kind of suggest some uncertainty around the timing of the next breakout and how long we might be stuck in this 30 to 31K range. I mean, if you remember last year, it's really proved as quite a sticky level, before spot even took the next leg lower back in 22. But over the past month or so, the hottest strike on Paradigm continues to be this December 40,000 call. So if you look on the chart on the left, that is that biggest bar there where it says 8,400. So there's roughly 7,000 of those 8,400 contracts of that 40K strike have been bought, and they've been in December, right? And to put it in perspective, the second largest open interest contract on Paradigm, to be clear, this is on Paradigm. This is not aggregating, Deribit flow as well. This is just Paradigm blocks. And the second biggest is the DEES 35K call at roughly 3,500 contracts, which is also a long interest. So generally, the largest positions from our takers are in these 33 to 40K strike ranges where our taker clients are significantly long. And it is quite interesting that compared to earlier in the year when we were seeing upside being put on, it was much more shorter dated. Like, David, remember back in Q1, we were talking about literally dailies being put through, or literally 1 week trades in these massive sizes. And long dated in terms of these big upside blocks that we were talking about were kind of 1 to 2 months. But now we're seeing most of this interest in December. We're seeing it out in March. March 24 call spreads that I'll put those flows up on the screen pretty shortly. But it kind of speaks to this uncertainty potentially around how long we are going to remain here. I mean, BlackRock ETF approval, I think we both agree it probably ain't happening in August, right?
Yeah.
And, there's another catalyst that not a lot of people are talking about. It's more of a longer dated catalyst that Michael Saylor at MicroStrategy is endorsing. But there is an accounting treatment change of Bitcoin where it's going to be classified away from an intangible asset, which effectively is going to make it easier for corporations to own the asset on their balance sheet. Because if you hold an intangible asset on your balance sheet, it is only subject to an impairment. So you can only write it down. So let's say that you own or let's say that you buy some Bitcoin when Bitcoin is 30,000, last year. And then Bitcoin goes from 30,000 to 18,000. Well, you are going to have to recognize a loss as impairment, but on the rally back up from 18,000 to 30,000, you cannot write it back up because intangible assets are only subject to impairment. And what Michael Saylor is saying is this is a big barrier for other corporations, that are subject under U.S. GAAP from actually owning this asset on their balance sheets. So he's been a very big advocate of changing this and changing the guidelines around the classification of crypto assets on U.S. corporate balance sheets. So we'll certainly see, but that's more of a longer dated sort of catalyst. I think he was on He's either on Crypto Banter or Bankless saying, he's kind of targeting March of next year as potentially this going through. But it's not going to happen for a while. But conversely, the taker interests are short the downside strikes. I mean, look at that left chart, right? So the taker open interest on Paradigm kind of has this, sell put buy call sort of risk reversal lean, which is a pretty consistent theme with the Paradigm open interest that we've seen in 2023, and perhaps speaks to some of the positive spot vol correlation that we've been seeing. And then on the right, this similar sort of analysis also extends to Ethereum, but much lesser to an extent than Bitcoin, as David was mentioning. Ethereum is just much less of the hot topic these days. Just given the cleaner Bitcoin narrative and potentially this sort of specter where the SEC is coming after them around securities. Just checking price action right now. Damn. So Ethereum now is up to 1935, up 3.5% on the day. So just quickly looking at the flows in July, definitely a bit of a quieter month. Hopefully things start to pick up a little bit more, after this XRP news, if it is in fact confirmed. But Bitcoin continuing to see action in these DEES 40K strikes or DEES 40K calls that we just spoke about. But then also some longer dated call spread buying, like in March. You see those March 35,000, 50,000 call spreads that are being bought, seeing similar activity in December as well as the September expiries as well. And in comparison, I mean, you look at Ethereum, right? Given their longer dated, like I don't want to say those are small trades, like they're not, but I mean, just compare to the flows that we were seeing last year, right? Where granted, those were call flies, a lot smaller risks, of course, you're going to have much more contracts that are being traded there, but it definitely feels like from our main takers that, Bitcoin is still the main interest. And then quickly, just in vol parameters here, the Bitcoin sort of upside, I guess euphoria, if you will, relative to ETH is kind of really just shown quite simply through this 25 delta skew, that bottom right chart, where Bitcoin is trading calls over puts basically across all maturities. Across every maturity, while ETH skew at the time of snapshot, this is going to be a lot different if I were to put it in now, given the move that we're having here. But ETH skew is puts over calls in maturities out to December. So the sentiment around this euphoria is not only in the flows, but it's also in the option pricing, which, as you'd expect, are certainly related. But implied vols back in the doldrums in the 40s post that CPI, and given the drop in Realize, I think Realize is back to 30 vol. You have this increase in the vol risk premium, and look, the longer we stay here, the more the vol sellers are going to come in. So I'm really hoping we break out. I can't because the vol sellers I kind of just tend to just hold this here longer.
Yeah.
What near conversation,
right?
Go on, David. Sorry.
So we've seen the term structure steepen up pretty significantly, right?
Yeah, exactly. The front end is really starting to come in, as you'd expect.
Yeah.
I mean, what are your conversations been like, over the past couple weeks or so around the rally? Like, what is the sentiment out there? Like, people I talk to is like, yeah, we're going to 40K in no time, but I'm also quite wary around pretty strong consensus to the upside like this. Yeah, it's usually contrarian signal.
I'd say it's been pretty mixed. Like I'm not seeing. Obviously, we've seen some really punchy flows to the top side, which feel very sort of directional in nature. I'm seeing quite mixed sentiment. Like, again, people not fully willing to embrace, fully willing to embrace this kind of new macro regime. And I do actually wonder if that's why we're seeing like the more bullish trades and the larger size get put on more in the back end, because it's like we know the pause is coming, and we know that's gonna be pretty positive for Bitcoin. But are we going to get another hike in July and then another one in September? It's kind of okay. That might be this kind of really sort of messy like little period where not much happens, and then we know it's ending. There's no signs of like inflation sort of picking back up. So I think that there's some that are concerned about the speed of certainly in equities and how quickly we've rallied there, and the idea that AI was this kind of new shiny thing and that could wash out all of those AI based stocks. And then obviously if NASDAQ and everything gets smashed, then it's going to just weigh on crypto. So again, I think there's been a reluctance broadly to like fully embrace it. I think it's been a good market for like RV role players to sort of play. A lot of people want to be kind of short front end and own that Vega for that optionality if we do sort of rip higher. So actually it'll be quite interesting seeing on this news how the front end performs, because I imagine people are quite short there. But yeah, I think overall bullish, but not we're certainly nowhere near that exuberant type bullishness that you'd kind of get nervous about. I still actually think from my conversations, people are under positioned risk generally, and certainly in Bitcoin. I think if you're a fund that is benchmarked to Bitcoin, you've probably underperformed. So you end up having to chase some of these breaks because you need to at least kind of keep track with your benchmark. So again, I think positioning the sentiment is kind of, whilst it's turning bullish, obviously we've seen some bullish flows. I don't think it's exuberant at all, which again keeps me pretty bullish. I don't think we're anywhere near to seeing that kind of blow off top yet, where you'd maybe go, do you know what, let's step back a little bit. This looks a little bit overdone.
Yeah, and I just ran some vol moves, kind of on the spot move here. It looks like a lot of, at least in the front end, as you would expect, given the spot outperformance in Ethereum versus BTC. Ethereum vols are now trading over BTC vols out through next week. Obviously we need to see how sticky this is going to be, and if we see a continued rally, but maybe the start of a little bit of this reversion, where BTC vols were just trading over ETH vols for so long. And I remember when we had a couple weeks ago, we had the Knox guys on, basically calling this reversion. Yeah. So look, I'll give a shout out to those guys, right?
Yeah. Yeah, it's a good, again, like it was lining up pretty well, right, for that mean reversion trade. Again, you're always looking on these things, but what's the trigger going to be? And maybe we've just got that. And Joe as well, this is like one of the things that, that I know you love about options, and me too, in that, they often give you pretty cheap ways to play these directional views. And there's some really good sort of trades out there that you can put on at the moment, and with vol so cheap. Again, if you're more of a vol player, it can be painful to sit in there and just bleed theta all day long. But if you're just directional, it makes a lot of sense. The guys that are sticking on these like deck 40Ks, and now I imagine people will start looking at some deck March, ETH, like you start looking at that 2.5K type levels and maybe upwards. But yeah.
Well, I think that's right. Yeah, because you just look at it in comparison to the crypto equities. The crypto equities have been granted they're expensive, much more expensive, because those things have been on an absolute tear, and they realize a lot more. But just in terms of, I was looking at some marathon December options, and those are trading at December at the monies are trading at 130 vol. You know what I mean? So it's just interesting.
Rips, right?
Yeah, I'm not saying it's unjustified that they're trading that expensive. It's certainly not. They realize a lot more. In a sense, those crypto equities are kind of levered, coin plays in themselves, right? And then you're trading options on these sort of levered coin plays. But it's just kind of just interesting to see, that dichotomy there.
And Joe, on the option stuff. So obviously, the last few weeks, we've seen obviously that deck 40K was a big strike and focus. Are we seeing sort of people even sort of roll those strikes up at all, or and out further? What's been going on?
I'm literally looking at my chats right now where this is starting to actually happen. Yeah. The timing couldn't have been more uncanny on that. Like, there's literally rolls going. Like, if you asked me like 5 minutes ago, I would have been like, no. We've seen a little bit of of people coming in to buy the dip. We saw this on Monday. Remember, we had that pretty decent sell off, and then we saw people coming on the July 14th, 31,000 calls, basically just playing for a play back to that top of the range. And I looked at the purchase price of where this counterparty got them versus where we were trading at the end of the day, and the guy was up like 60% on his money in like an hour because we basically crashed. He was buying the call options by the dip, and then we kind of rallied back again towards the top of the range. Yeah. And for a play like that where you're kind of just looking, potentially for a trade to not. Or to close out before maturity, you don't necessarily need to go above 31,000 to make money on that trade. Is my point. Just lastly, before we finish off here, wanted to give a quick update on the inner dealer flow on Paradigm. So we've discussed this in our institutional insights report that we should have Justin link in the description, which is on our website, as well as previous episodes of The Big Picture. And what I mean by this term interdealer, as a refresher, in the option market refers to trades between liquidity providers who operating market-making desks as their core business. So we basically look at all the trades that have occurred on Paradigm and classify the trade as interdealer if both the maker and the taker on the trade is a dealer per the definition I just gave you, i.e., they run core market-making businesses, whether that is, listed markets or in the over-the-counter bilateral markets. And the main takeaway is as spot went range-bound from March to June, the organic taker interest started to disappear from the market a little bit. And we certainly felt it too. And more of the Paradigm trades as a percentage of the total were interdealer. Then I ran the numbers today. Fast forward to the BlackRock ETF news and then the subsequent rally. And what do you think happened? Well, the organic taker interest came back through significant upside interest, like those December 40K calls that we mentioned earlier. So despite the market remaining range-bound in July, the interdealer percentage of all our flow is only 25%, which is quite low given this sort of range-bound price action that we've seen. Like, we've continued to see plays to the upside by natural takers that, i.e., are not market makers, kind of playing for this next spot leg higher. And, the longer spot remains here in this range, obviously the higher probability that this metric is, continuing to tick, will tick higher as kind of organic taker interest take a step back from the market. And then once we see a continued rally, it will tick higher again. But it is super interesting. And I mean, it's not entirely unexpected, but it's kind of cool to kind of have the data to show that, hey, this isn't just David and Joe saying that the taker interest is returning because we're rallying. This is actually data showing that this is actually the case on Paradigm, and that is shown by that metric, by that line falling from 35% down to 25%. But that's all for me. David, do you have any closing thoughts? Or if not, we can just end it here.
Yeah. I think just to kind of summarize the view at the moment. So I think that peak rates, peak inflation narratives largely played out in H1, but I think set to go into overdrive in H2. The lag feed through from monetary policy plus China exporting disinflation. I think we're going to see inflation quickly back to target. We've got the dollar breaking down. We've got improved sentiment and this narrative shift post the BlackRock ETF announcement. The institutions are coming. And we're combining this sort of macro with that narrative shift, and which I think is going to combine beautifully to see crypto take another leg higher into the second half of this year. And so I think those debt 40Ks look a good place for me, Joe.
Well, as we speak, Ethereum is up 4.2% above 1950. So let's keep the hopium going, and until next time.